করেছিস কি?
আমি স্টার্ট করে দিয়েছি।
রাইট, ঠিক হয়েছে।
হুম। আপনি লাইভ আছেন।
Hello, Satudru.
হ্যাঁ, আপনি লাইভ আছেন।
Am I audible? Satudru?
হ্যাঁ, you are.
May I start?
Yeah.
Okay. Good afternoon. On behalf of the Department of Commerce, Raja Peary Mohan College, I heartily welcome all the participants in this webinar. I also convey a very warm welcome to all our distinguished guests. Today's webinar is organized by the Department of Commerce in collaboration with IQAC of Raja Peary Mohan College. The title of the webinar is Budget 2020, an overview. Various key points and major amendments in the Budget 2020 will be discussed in this webinar. We are passing through a very tough time in our social and economic life due to outbreak of COVID-19 pandemic all over the world. Indian economy is severely affected by disruption of business and commercial activities due to the prolonged lockdown and adoption of social distancing policy. With a persistent downfall in economic growth inherited from the earlier period, the Indian economy is likely to experience recession ahead due to complete shutdown of activities in major sectors of the economy. In this context, the role of the budget is significant for proper allocation of resources and generation of output and employment for economic development. Union Budget 2020 has brought some important changes and a new income tax regime at lower rates as an alternative option to the old regime without facilities of exemptions and deductions. The objectives behind such policy is to reduce the tax burden and compliance, to increase disposable income of the people, contributing to growth of the economy. I think today's webinar will be interesting to all the participants, and they will get answers to many queries in their mind from the enriching discussions and interactions here. I hope they will be properly guided for their future tax planning and decision making. We now begin the session with the welcome speech by our Honorable Principal, Dr. Sudeep Chakraborty. He has sent us an audio message which is now going to be presented to you. I would like to request the administrators to play the audio clip sent by our principal.
নমস্কার, আজকে
রাজা প্যারি মোহন কলেজের ডিপার্টমেন্ট অফ কমার্স তারই মূলত উদ্যোগে এবং আইকিউএসি সহায়তায় একটি ওয়েবিনার হতে চলেছে। বক্তা অধ্যাপক শুভায়ন বসু, অ্যাসোসিয়েট প্রফেসর, আনন্দমোহন কলেজ। এছাড়া কলিকাতা বিশ্ববিদ্যালয় এবং সেন্ট জেভিয়ার্স কলেজেরও তিনি অতিথি অধ্যাপক। আমি প্রফেসর বসুকে নমস্কার জানাই, আহ্বান করি এই ওয়েবিনারে আমাদের কলেজের তরফে তার সুচিন্তিত বক্তব্য রাখার জন্য।
We convey our heartfelt thanks to the Honorable Principal
শতদ্রু নিজেকে আনমিউট কর, নাহলে শোনা যাচ্ছে না। শতদ্রু নিজেকে আনমিউট কর, নাহলে শোনা যাচ্ছে না স্যারের বক্তব্য।
আমি আশা করছি সেই জায়গাগুলো আলোকিত হবে আমাদের এই আলোচনার মধ্য দিয়ে। আমি কমার্স ডিপার্টমেন্টের অধ্যাপকদের, অধ্যাপিকাদের এবং আইকিউএসির কোঅর্ডিনেটরকে, সদস্যদের, কলেজের ছাত্র সংসদ এবং সাধারণ ছাত্রছাত্রী, শিক্ষাকর্মী, যারা শ্রোতা, অতিথি, আমাদের আজকে যারা বিভিন্ন কলেজ থেকে যারা অংশ নেবেন, শুনবেন, সকলকে আমি আন্তরিক ধন্যবাদ জানাচ্ছি। সবাই ভালো থাকবেন। আশা করি এই ওয়েবিনার আপনাদের সকলকে সমৃদ্ধ করবে। নমস্কার।
স্যার আনমিউট করুন, স্যার আনমিউট করুন।
We convey our heartfelt thanks to the Honorable Principal for his inspiring speech. Thank you, sir. Now we proceeding to the webinar. We are highly privileged to have with us today our resource person, eminent scholar and academician, Honorable Speaker of this webinar, Professor Shivan Basu. Sir, on behalf of the Department of Commerce, I convey my warm regards and sincere gratitude for giving us time to deliver a speech on such an important topic of new tax regime in budget 2020. Thank you, sir. Participants are requested to put all their questions and remarks in the chat. All of this will be taken up in the question answer session. Now I request Dr. Sudhin Kumar Bera, our senior member of the Department of Commerce, to give an introduction of our honorable speaker, Professor Shivan Basu. Dr. Bera, please.
হ্যাঁ আরূপ ভাই বলো।
Good afternoon, everybody. I have been advised by the organizing committee to introduce today's speaker of this webinar. It is my great pleasure to introduce Professor Shivan Basu. In fact, the name of Professor Basu is very much familiar to the faculties of Commerce fraternity, but I must say few words about him for our other distinguished participant of this webinar. At present, Professor Basu is working as an associate professor and head of the Department of Commerce, Anandamohan College, Kolkata. He is the visiting faculty of Department of Commerce, Calcutta University, and also Department of Commerce, St. Xavier's College, PG Department. His teaching experience is more than 35 years. Further, he is a member of the UG Board of Studies Commerce and serving the boards of studies since 2008. Moreover, Professor Basu is an associate member of the Institute of Chartered Accountants of India, as well as he is a cost and management accountant. His proficiency in tax subject made him very popular. He is a regular speaker of various seminar and workshop organized by Association of Chartered Accountants of India, as well as other organizations also. He is the author of so many books, very popular to the commerce students. Some of the books can be named as Income Tax Simplified, Standard Problem on Accountancy, Poribyay Shastre Rupurekha, etc. So, the participant, let's join to welcome Professor C.A. Shubhayan Basu in today's webinar. Over to Professor Basu, please.
Good afternoon to all the participants. Today is 7th August, 22 Shraban. This is the day in 1941 when the Mother India lost her, I think, the most illustrious son, Rabindranath Tagore. I offer my pranam, but life has to go on. So now we are moving into our work. So today topic is Budget 2020 and overview. So you are well aware that this Budget 2020 was presented by the Finance Minister on 1st of February 2020. And it has been already enacted. This budget basically contains 104 amendments. So it's not possible within this time period to discuss all the 104 amendments. Besides that, some amendments are consequential. I'm giving an example. See, there is a change in 44AB, the tax audit. The threshold limit has been increased 1 crore to 5 crore, subject to certain other conditions. And a lot of sections are related to 44AB, so there are a lot of changes. So these are the consequential changes. So what my agenda is today, I'll take three important aspects. Next slide, please. My agenda is residential status, dividend taxation, and new scheme of taxation for individual and HUF. These three are directly or indirectly or affected the personal taxation, but to me, these are the three most important concepts hidden in the new budget. So I start one by one. And what I will do, I will talk of not only the amendments, but the backdrop. Against what it has been changed, why it has been changed. The logic is very important. When a change, it's not that change has to be made, so there is a change. So there are some logic behind the changes. So I will try to discuss those items one by one. Next slide, please. First is residential status. Now, residential status last changed, if I correctly remember, in my college days or university days or my CA costing days, the provisions and the first major change is made by the 2003 Finance Act from the assessment of 2004-2005 by changing the clause of 6 subsection 6 following a very famous case, Gujarat High Court case, Pradeep G. Mehta versus CIT in 2002. It's a very interesting case. This case gives a clue to the income tax authorities, so they are jump on it and they change the total 6.6, right? Now after that there is a change after so long period from 2004-5. Now they are changing in through budget 2020-20. Now the problem is why the change is. One can take this as a change in the 6.1 and 6.6, but to me it has to be seen from the international taxation point of view, because some of the assessees are using this residential status as a part of their tax planning to evade taxes. It's very important. It is a provision, it's a evasion, so that there is no evasion. You know, India is a member of the G20 group and they are going by the action papers prepared by the OECD, so that there is no tax evasion, and we are all aware of a new concept is coming called base erosion and profit shifting, BEPS. So these changes to me is not directly from this normal taxation. This is from the international taxation point of view. Now, what are the changes? There are, you see, there are three important segments. Amendment of section 6.1. Now, what 6.1 talks of? 6.1 talks of what the resident. There are two clauses. If you satisfy any one of the clauses, first one is 182 days present in India. Second one is 60 days in the previous year and 365 days during 4 previous years. So if you satisfy one, you become a resident. But if you remember, under 6.1c, there are two exceptions. Exceptions means the period of 60 days will be replaced by 182 days. There are two exceptions. First exception was an Indian citizen who is going for the crew of a ship, or a person who is moving out of India for employment purpose. And second clause talks of when a person who is residing outside India visit to India. For these two cases, that period of 60 days I mentioned earlier will be replaced by 182 days. Now in this case, they have made one changes. What is that? They said in the second clause, that is a person who is residing outside India comes to India, and now they have added one and they said and a citizen of India whose gross income excluding foreign income exceeding 15 lakhs rupees. Once again, and as an Indian citizen, mind it, an Indian citizen, an Indian citizen or a person of Indian origin also. Sorry, here 115C is also there. A citizen or a person of Indian origin who living outside India visits India and whose total income excluding foreign income exceed 15 lakhs of rupees, then these 182 will be replaced by 120 days. So for this type of people, the period is not 182 days. This period has been reduced to 120 days. Now the question is, what is the foreign income? The foreign income means when an income accrues and arises outside India. Simple. They have given also what is the foreign income. So this is change number 1 of 6.1. And now the second one I am coming, and you will all agree with me that residential status basically depend on how many days you are staying in India. And broadly speaking, it doesn't have it doesn't impacted by the citizenship, right? A foreigner may be a resident of India, and Indian may be a non-resident. But now they have issued a clause, very interestingly, when it is impacted only your citizenship, there is no period of staying in India. That is 6.1a. What 6.1a talks of? It's a newly introduced section. It talks of an Indian citizen. It is only an Indian citizen whose foreign income, whose total income excluding foreign income exceeds 15 lakhs and who is not supposed to pay any taxes anywhere in the world due to his residential or any other things, then he will be treated as a resident. Am I clear? Now thing is that suppose I am a non-resident, right? And I have made the things in such a way that I am not a resident of any of the country in the world. I am not a resident. So some of the incomes on which I am not paying taxes anywhere. So now they said, if this is the case, you are not paying taxes on certain income anywhere in the world. So and if you are an Indian citizen and if your total income excluding foreign income exceeds 15 lakhs, then you will be treated as a resident of India. So there is no number of days staying, nothing of the sort. The only thing is simply whether you are paying taxes or not. I think I'm clear. So this is a huge changes. This is why I'm talking. This is an international taxation concept. It's not a natural case, right? Now they have also amended section 6.6. You know, 6.6 talks of who is a resident but not ordinarily resident. I'm in a view that a lot of books, a lot of people are saying resident and ordinarily resident, but the problem is Income Tax Act hasn't defined resident and ordinarily resident. Income Tax Act has defined resident. Yes, you can see 230. They defined non-resident, but they haven't defined resident and ordinarily resident. They define resident and not ordinarily resident under section 66. You know what 66 talks of?
আমাকে পার্টিসিপেন্টরা বলছে ইউটিউব থেকে যারা দেখছে তারা সাউন্ড পাচ্ছে না, সবাই ওই সাউন্ড পাচ্ছে না।
স্যার মিউট করুন, স্যার মিউট করুন।
আচ্ছা, what is 66? Now 66 talks of there are two conditions. If you satisfy any one, then you will be treated as a resident and ordinarily resident. What was that? You must be a one of the
ওয়েবিনার গ্রুপটা তোমার কাছে আছে?
One of the conditions is
ঠিক আছে, আচ্ছা ঠিক আছে, ওকে।
Non-resident for 9 times out of 10 previous year, and physical presence in India for 729 days or less during 7 preceding previous years. Right now, the problem is in case of 61A, when you say an assessee is a resident, then the problem comes whether he is ordinarily resident or not ordinarily resident, because you know section 51 talks of the taxability. If I am an ordinarily resident, my global income is taxable, but if I am not ordinarily resident, then only 2 incomes are taxable for me. What is that? One is business, income from business, which is controlled from India, and the profession which is set up in India. Now the problem comes in case of 66. What happens to 61A? And you know this, there is a major change as per the budget paper and the act. There was a huge change, but that concept was different. But when the act came, it was much, I think, benefit given to the assessees. Earlier one was very, one time was very harsh. So now they make also changes to 66. And what this, the talks of the, in case of 66, that 9 out of 10 is there, then 729 7 is there, and they said, and they have included, and a Indian citizen or a person of Indian origin, right, who resides outside India, comes to India, and whose income excluding foreign income exceeds 15 lakhs, and who stayed in India for more than 120 days but less than 182 days, to be treated as resident but or not ordinarily resident. So there was a change in 61, the corresponding change in 66 also. Now comes to 61A. This is a very interesting thing. They have also included that person who has been treated as a resident under 61A will be treated as resident but not ordinarily resident under section 66. That means there are only 2 incomes will be taxable. That is that income from business, which is controlled from India, and income from profession, which is set up in India. Right. So these are the major changes in the residential status, and how that is impacted. Just think of a case. I'm an assessing officer. Earlier, what happened? If you are a non-resident, I am not at all concerned of your foreign income, because your foreign income is non-taxable. So you are not my client. But now things, what happens? I'm an assessing officer. I got a client who, I got an assessee who is a non-resident. Now I will have to check whether he is paying income or whether he is paying tax on the income in any countries. Yes or no. If it is no, then I will have to check whether his gross income excluding foreign income exceed 15 lakhs. If it is yes, then he is my client. So he is a resident of India. So you think that assessing officer now work has become huge. A lot of people are there. Take it a case, because I talked with a lot of practicing chartered accountants. They said a lot of persons, especially in the Middle East, etc., a lot of incomes are not taxable. They are not paying taxes on income. They have earned income but not paying any taxes. So this is a huge change. And once again, this is a change which is basically, to me, is from the point of view of the international taxation. I think up to this point I'm clear. Next, I move on to the next one. Next slide, please. Next slide. Dividend and unit income tax. It's a
এবার একটু
huge.
বন্ধ
It's a huge.
সন্দীপন স্যারকে এই নেক্সট স্লাইডের আগেই একটু স্যার বলো, আমি বলবো।
Yes.
শুভেন্দা,
হ্যাঁ,
জাস্ট একটু ইন্টারাপ্ট করছি, আমাদের ইউটিউবে একটু প্রবলেম দেখা দিয়েছে। সো বিফোর ডিসকাসিং দ্য নেক্সট স্লাইড উইল প্লিজ
okay.
I would request our support team to continue the
No problem. I'm sorry for the interruption.
Sandipon and Shatadru, please take care of the matter.
Yes.
Shatadru, am I to use a headphone?
No, sir, it's perfectly all right.
Okay.
It's perfectly all right.
Okay.
শতদ্রু, যা মেসেজ আসছে বলছে যে ইউটিউবে নয়েজ প্রবলেম হচ্ছে, মনে হয় দেখতে অসুবিধা হচ্ছে না, নয়েজ প্রবলেম হচ্ছে।
হ্যাঁ জানি স্যার, এটা অনেকক্ষণ আগে থেকে করার চেষ্টা হচ্ছে, হোপফুলি ঠিক হয়ে যাবে।
আচ্ছা,
ওটা কাজ করছে ওটার উপরে, হোপফুলি ঠিক হয়ে যাবে।
ওকে।
স্যার প্লিজ বলুন এবার, ঠিক আছে।
Thank you. Thank you. So the next segment is dividends, unit income taxation. There will be huge change. These individual taxpayers now you have to face a lot of burn of it. So now what is the existing scenario? Existing scenario was a company who is paying the dividend. They are supposed to pay dividend distribution tax under section 115(o) at the rate of 20.55529%. And this same dividend is not taxable in the hands of the shareholder under section 1034, but subject to section 115 BBDA. This BBD has been included 2 years back. And what is 115 BBDA? That is, if your dividend income exceed 10 lakhs, then on the excess you have to pay tax at the rate of 10%. But otherwise, if it is less than 10 lakhs, then shareholders are not supposed to pay any taxes, and the company is paying the dividend distribution tax. So this is and this is same also for the unit, that the unit holders, when they are declaring the giving you the unit income, so under 115R there are several rates, they have to pay taxes on that, and the unit holders, in the hands of the unit holders under section 10 subsection 35, it is not taxable, right? That was the provision, existing provision. But now there is a 180-degree changes. Total it has been changed. Now what they said? They said the DDT and the distributed income tax has been abolished. That means the company is no longer paying the dividend distribution taxes, or the units or the specified companies, they will not pay any taxes on the distributed income. So automatically now it has to be taxed in the hands of the shareholders or the unit holders, as simple as that. So the unit holder or the shareholder now have to pay taxes. So just think of it. Say I'm giving an example. Say last year someone got in investment in shares, and he or she got a dividend of say 50,000. It was non-taxable. But now from this year, if he or she got a dividend of 50,000, that will be included in his or her income as income from other sources. So there is a major change. So this is a very important one, how it is impacted the shareholders. And once again, to me, I'm not very sure, but this is my own apprehension. I think in that way, there may be some pressure on the international section also. I will show you why this is so. Now, tax implication in the hands of resident shareholders, I think the impact is very simple. I lose. Whatever may be the case, I lose, because earlier I am not supposed to pay any taxes, but now I am to pay taxes. And the most interesting concept is, I think we are all aware of, in case of an individual shareholders, individual assessee, I should say, that if his or her income exceeds 5 crore, then a surcharge is 37% plus HEC 4%. So actually he or she is to dish out a tax at the rate of 42.744%, which is called maximum marginal rate of tax, 42.744%, right? So just think of it as resident shareholders. Previously I am not paying any taxes, but due to these changes now I am, because 1034 has been abolished, 1035 has been abolished, 115(o) has been abolished. There is no, not abolished, but only some limited case. So technically now I have to pay the taxes. Say if I'm 30% tax bracket. So if my dividend income is 50,000, so 50,000, 30%, 15,000 plus HEC. So I have to now dish out more taxes. Now what happens to non-resident shareholders? It's a very interesting case. I think in this way, it might benefit the non-resident shareholders. Why I'm saying so? Because you are well aware of, there is a concept called double taxation avoidance agreement, and under DTAA there are several clauses that whatever tax you pay in country X, suppose I'm a resident of country Y, but I earn income in country X, so I pay tax in country X. So whenever I will pay tax in country Y, I will be allowed a deduction of to the amount of taxes which I paid in country X. So my country-wide taxation will be gross tax payable in country Y minus tax payable in country X. So that net figure will be my actual tax payable. Now think of a non-resident share. What earlier happens, earlier the tax was paid by the company, so shareholders are not paying the taxes, so they don't get the benefit of this set off. Now, since it has been shifted, now what happens? This withholding tax, we call it withholding tax, and if you go through different DTA, the tax rate is max. Most of the cases I find, most cases it is 10%, some cases 5%, some cases 15%. So what happens now? A non-resident, what they happen? They will pay taxes at the rate of 10% in India, and when he or she will transfer the amount to his own country, now whatever the tax payable, they will get a deduction for the tax payable in India. So technically their effective rate of taxes will come down. So non-resident shareholders might get some benefit, but the resident shareholders, it's a loss. All through it's a loss. But non-resident shareholders, this is why I'm talking of, there might be some pressure from the international quarters so that this dividend has been totally changed, because a lot of major player, they are earning a lot of dividends, but since they are not paying any taxes, they are not getting any benefit in their own country. So this is the, so please bear in mind from this year, if you do have any shares, it's dividend. If you do have any units which yield dividend, so whenever this dividend will be given to you, you are supposed to pay taxes on that. Right now, before I move into the third one, I wish to transgress a bit. I wish to go I should say rewinding. I wish to take one small case because I find a lot of people are confused. In the last budget 2019, there was a provision in house property that now onwards, earlier one the provision was if you have one house property, it is to be under 23(2), it is to be taken as nil. But if you have more than one house property, then one house property will be self-occupied and other house will be deemed to be let out. Right? Now the concept is, in the last year they said no, it should be 2 houses. That means if I have 2 houses which are used for the self-occupation, income should be nil. Right? Now the concept is, from this I can get a deduction only on interest on loan under section 24B. So now 24(1) is there, 24B, and the limit was 2 lakhs. There are certain conditions, right? Because you know still 30,000 is there, because if I take a loan for the renovation or the repair of the house, it is not 2 lakhs, it is 30,000 still. But if I take a loan for the construction of the house or constructing one floor, so that part it is 2 lakhs, right? Now when there are 2 houses, very interestingly, they haven't said the interest will be 2 plus 2, 4 lakhs. They said interest cap is 2 lakhs. So if you have 2 houses agreed, but your interest cap is 2 lakhs, you won't get more than 2 lakhs, including your pre-construction benefit, if pre-construction interest, if any. Right? So mind it very carefully. I have 2 houses now, both are self-occupied under 23(2), but the problem is whenever I will compute the income, my total interest under 24B cannot exceed 2 lakhs. Suppose in the first house, I took a loan and the interest is 1,30,000. And in the second house, I also took loan and the interest is 1,80,000. So if I take 1,30,000 from the house 1, in the house 2, I can get only 70,000. So cap is 2 lakhs. Right? But I am going through, this is one part, agreed. That is, but someone may raise a question, sir, if I have got 4 houses, now how shall I compute? All 4 houses are self-occupied. Now how shall I compute? How do I know which one is beneficial to me? Which 2 houses will be taken as self-occupied? Which 2 houses will be taken as let out? I have you can go for a thumb rule. The thumb rule is, first assume all 4 houses are self-occupied. Compute the income. Next step, compute all 4 houses as let out. Compute the income. Then you take the total of combination H1, H2, H3, where your income is maximum, which 2 houses your income is maximum, that 2 houses should be taken as self-occupied and other 2 houses to be taken as deemed to be let out. That is a thumb rule. There's no escape from that. It has to be, because there are no simple things. because I know some people said that it's very simple. Higher the municipal value, that should be taken as self-occupied, but there are a lot of issues are there, like interest on loan. That house I have highest municipal value may not have interest on loan. Some house which is taken as self-occupied. So a lot of things are there. So this is a thumb rule. But I wish to throw some light on the other aspects. I'm going through other related sections. In capital gain, I'm saying, yeah, what happened to 54? You know that 54, if you have a long-term capital gain on sale of a house, if you purchase a house to the extent of this capital gain, the entire amount is exempted. And now earlier one, it was only one house. Now I'm interested to see whether, since there is a change in section 23(2), how that impacted this 54. And in 54, there is a change. Agreed. They said it's a very interesting change. They said if your gross long-term gain is within 2 crore, then you can purchase 2 houses. Earlier it was 1 house. Now they said no, you can purchase 2 houses. So, but the condition is your LTCG within 2 crores. It doesn't exceed 2 crores. Fine. So I know that this benefit has been well taken care of by 54. Now come to 54F. What 54F talks of? 54F talks of if you got an asset other than house property, suppose you are having a gold jewelry, you are selling it, then whatever the long-term capital gain, you can get an exemption under 54F, provided you have purchased a house, 1 house. Interestingly, 54F, there is no amendment. It is still 1 house. So you can't get 54F if you got 1 house. And if you think that now 2 houses is self-occupied, I can purchase 1 house by selling the gold, you cannot do that, because if you've gone through 54F, there is no change. 54F remains the same. I don't know. I think there should have been some changes, but 54F is totally silent. It was as per the old provision. And the third one is, you are well aware of, this is my own curiosity, I'm just going through these sections. A new section 80 EEA. So 80 EEA talks of, you know, that interest on loan you have taken for a house, subject to certain conditions. That loan must be taken from owner after 1/4/99 and up to 31st/20. But this budget had extended it to 31st/21, and your stamp duty value does not exceed 45 lakhs. Blah blah. So you can get a deduction of 1,50,000 over and above 24B. But the problem is 180 EEA. There was a condition that you must not have any other houses occupied, only 1 house. The new house you are purchasing, suppose I am purchasing a new house for my own residential purpose, I don't have any other houses, then I can get 80 EEA. And interestingly, 80 EEA, there is no change. So if you think that I will purchase a second house and I will get 80 EEA, no, you can't get. You can't get 80 EEA for the second house. It's very clear. 80 EEA is only for a specific case for an assessee who doesn't have any self-occupied house or doesn't have any house. He or she is interested to purchase a house, then only 80 EEA is applicable. So it is not applicable for your second house, right? I think this part is a lot of interesting things are there. I just going for this, and now I move on to the third section. Please change the slide. Change the slide, please. Devashish, please. No. Earlier one. Devashish, earlier one. No, after that. Residential status after that. After that. Achha, sorry. Okay, thank you. Now, no, ठीक है. May make the earlier one. Devashish, may make the earlier one. I will show the impact analysis of the dividend. I take an interesting case. Suppose existing scheme and new scheme. Earlier one say a company is to declare dividend 120 and new regime also 120. No problem. But earlier one, the company has to pay 20% DDT. So it should be 20 by 120. So 20 is actually dividend payable under the old scheme or the existing old scheme is 100. Now they will pay you 120 because the company is not paying any dividend distribution tax, right? And under the existing scheme, shareholders are not paying any taxes. And under the new scheme, shareholders are paying taxes. I assume 20%. You can calculate at 30%. You can calculate at 30% plus surcharge. You know, surcharge is 50 lakh to 1 crore, 1 crore to 2 crore, like that. So 15%, 20%, 37%. But I take a simple case of 20%. So how much you are paying now? 24. So actually, net income of the shareholders earlier was 100. Now it is 96. And the government is richer by ₹4. Earlier one government is getting 20 as a DDT from the company. Now government is collecting 24 from the shareholder. So tax liability, so government coffer will be increased by 4. I think this is clear, and this is why I am telling that non-resident are very interested, because now they are getting a more dividend. Earlier one they used to get only 100, but now they used to get 120. So they used to get more dividend, which they will pay the dividend, their tax, and under DTA they will get a refund of the taxes in their own country. Okay, next one. Next one. Devashish, right. Now I move on to the third section, that is the individual taxation. There is a huge changes, but once again I will talk the backdrop. Is it completely new? I don't think so. If you go for the Finance Act 16, the assessment year 17-18, the first indication was there. They have introduced a section called 115BA, where a company can pay tax at the rate of 25%. The normal rate we know 30%. At the rate of 25%, provided they satisfied 1, 2, 3, 4, 5, 6, 7. So I think that is the starting point. Starting point is not that today in one fine morning they have changed the whole thing. Not at all. They have slowly injected the thing much earlier, 2-3 years earlier. When 115BA came, my sixth sense is telling that within 2-3-4 years there will be a big changes, because now the government is moving away from giving the deductions. Now it will be simple. You earn, you pay taxes. No more deductions are allowable. Deductions will be very few, and within 2-3-4 years you will see a lot of deductions will be taken away. Right now, what they said, and plus you are well aware of, on 30th September 2019, the government brought an ordinance. It's not an act, ordinance, through which they have inserted 2 sections, 115BA, 115BAB, where a company can pay taxes at the rate of 22% or 15%. Just think it of 15%, provided some conditions are being fulfilled. Right now, when I'm discussing this, it reminds me of my college days. I must confess to you, I am a migratory boy. In my school, I was in the science stream. Then subsequently, I changed to commerce stream. And in physics, there was a chapter called calorimetry, where there's a rule of heat lost equal to heat gained. And I think this is similar to a benefit lost equal to benefit gained. So when it is benefit lost equal to benefit gained, we call it, you are all aware of indifference point. So in this point, both are equal. But if there is not equality, then sometimes old is beneficial, sometimes new is beneficial. And mind this one thing very carefully. It's not that new is beneficial to everyone. I will come to that. But just think it of now what comes to that. Now taking the cue from 115BA, 115BA, 115BAB, the government now has been thrusted this upon the individual and HUF assessees. Now they have introduced a new section called 115BAC. And what is 115BAC? Now this is for the first time that individual tax rate has been enacted inside the Act. If you see the Act, these rate of taxes are not forming the part of that. It's a part of the other thing, schedules. After that, there are the rate of taxes. Now this is for the first time for an individual tax rate is given for the total income from tax payable. Now they have given the rates. I'm not reading the rates, you know, and you see that one interesting point. There is a jump of 2,50,000 each stage, and the jump 5% in the rate. Simple. The formula is 2,50,000 in the income, jumping off of 2,50,000, and jumping off of tax rate is by 5%. Next one. Next one. Devashish, next slide. Now that is the benefit gained. The way I told hit lost equal to hit gained. So now I discuss the benefit gained by paying lower amount of taxes because rates are lower. Now you must know what are the benefit lost. That's very, very important. What benefits are lost? So I'm discussing each point. Now you lose 10(5) lift travel concession. No more. It will be fully taxable in your hands. 10(13) house rent allowance. We are used to get some deductions. You won't get. The entire house rent allowance will be taxable. Suppose you get 5,000 as HRA. So 5,000 into 12, enter 60,000 will be taxable. 10(14), you know, there are certain special allowances which are exempted, fully exempted on the conditions that the entire amount has been spent for official purpose. Now, out of these two, I think they have given benefit to only two, that is the traveling expenses on tour or transfer or the conveyance expenses or for official job. Other than all other are fully taxable. 10(17) is, you know, this is a salary of the MPs and the MLAs daily allowance. Now that will be taxable. 10(32) is if you have got a clubbed income, that is the income of your minor child. If it is clubbed in your hand, then you will get 1,500 per child. So that benefit is gone. And 10AA is the SEZ. Although I'm applying SEZ is not that important for us at this point. So I think that 1, 2, 3, 4 sections which impacted us. That is 10(5). Your lift travel concession, 10(13) house rent allowance, 10(14) special allowances, and 10(32) that is the clubbing. Other two, it's not directly impacted us. One is for MPs and MLAs and 10AA is for SEZ. Next one is you lose 16(1), 16(2), 16(3). So no standard deduction of 50,000. No 16(2), it's not important entertainment allowance, which is only for the government employees now. And 16(3) is your profession tax. So you are not getting the deductions of 16(1), 16(2), and 16(3). Now please come to the last point. And this one is not very well highlighted, I think. If you read 115 BSc in subsection 2, there is a very interesting clause. No exemptions and deductions on allowances and perquisites. So this is my own interpretation because I haven't seen any books coming on to the new one. That means whatever the exemptions or deduction I'm getting on allowances like children education allowance, children hostel allowance, this will no longer be allowed to me. Although they have not specified in these cases, but under this one they say no exemptions and deductions on allowances and perquisites. That means there will be no exempted perquisites now. So I need to see this in the black and white. What are the interpretations? But if you read 115 BSc, they have specifically written no exemptions and deductions on allowances and perquisites. So it's a huge loss for the salaried person. Right? This is one very important point. Then 24B is interest on loan, but it is only for the self-occupied house. Be careful about that. If you got a house which you have let out, you can get 24B. No problem in that. But if you got a self-occupied house, then you won't get 24B. Right? Then this is the business one. Section 32 is depreciation. No, you will get depreciation, but you will not get is additional depreciation. You won't get 32AD. 32AD is you know that its allowance is given if you start a business in a notified backward area of West Bengal, Bihar, Andhra Pradesh, and Telangana. Then you are getting 15%. So 32AD will be not there. 33AB, these are not that important. That is the tea, coffee, rubber. 33ABA, then 35. 35 is the scientific research. What you will not get, I am simply writing 35. So please don't assume I will not get 35. No, you will get 35. You will get 35 only for your in-house expenses, capital expenditure and revenue expenditure. If you pay to the someone else, you know that I can pay to someone else and I can get a deduction of 100%, 150%. That part you will not get. You will get 35 only for your in-house research expenditure. Then 35AD, you know that there are certain special businesses that you won't get, and 35CCC, which is not very important in agricultural extension program. So if you are, even if you are a businessman, so you lose a lot. You lose 32, you lose 32 AD, you lose 35, you lose 35 AD. So these are the very important deductions. So you lose it. Then 57 2A, this is income from other sources. You are aware of that if I got a pension, it is taxable under the head salary. But suppose on the death of the original one, say in case of wife, his husband, or in case of husband, his wife is getting the family pension, then it will go under income from other sources. And there is a provision that if you got a family pension, then you will get a deduction at the rate of 33.1% of the pension received, or 15,000, whichever is less. So no more that deduction. So if a family pension holder, if he or she opts for the new scheme, he or she will not get the benefit of 57 2A. And finally, the most important for us, deduction under Chapter 6A, that is 80 you won't get, except 80 CCD2, 80 JJAA. Now I'm come to CCD2. 80 CCD2, what is 80 CCD2? 80 CCD2 is National Pension Scheme, and 80 CCD2 talks of employer's contribution, not mine. So employer's contribution, it has been changed, 14% of salary for this, and for government employees, for others it is 10%. So only that is applicable. So it is not if you are under NPS, that is the government employees, or other employees can now covered under NPS. This you will get an 80 JJAA. Technically, this is not for us, it is for the businessman. If you are doing a business, if you employ new persons, then you can get 80 JJAA. So if you think of a common man like us, we are not getting any benefits. 80C, 80 CCC, 80 CCD, 80D, 80 DD, 80 DDB, 80 G, 80 GG, 80 GGC, 80 TTA, 80 TTB, 80 U, nothing. We will get nothing, right? So in this context, I need to discuss certain important issues. Okay, I will discuss the benefit one. So next one. Next slide, Devashish. Benefit lost, continuing. House property loss, you self-occupied. Definitely, because if you are a house property loss on let out, that is not affected. No set off of loss from house property, self-occupied, you cannot do. You cannot set off your carried forward losses, which is related to the deduction which is being disallowed, and unabsorbed depreciation. To the extent of additional depreciation you won't get. And I think senior citizens now, they don't get the benefit of 3 lakhs because 115 BSc hasn't make any differences between the senior citizen and the non-senior citizens. So these are the losses. Now the question is, whenever I make an investment, to me, this is my own perception, I have 2 objectives. One is primary objective, one is secondary objectives. For some investment, my primary objective is to get tax benefits. Say I'm giving an example. Say I am depositing to PPF. So my primary objective may be, Baba, I have to take 1,50,000. So say my total comes to say 1,10,000. So I deposit 40,000 in PPF. I get 1,50,000. Plus, I'm not telling you don't have a secondary objectives. Definitely, you will get some interest which is exempted. But to me, what is important is there are a lot of investments or my expenses where primary objective is not to get tax benefits. These benefits are given since I made an expenditure like that. So I'm giving a simple example. Say 80 DD. I have a person who is dependent on me and who is physically handicapped, and I am maintaining him. So I am maintaining him not for get the tax purpose. This is my duty to maintain. Since I am maintaining, I am doing a good job. They said, okay, you can get a benefit. So the question is, or say extreme case, 80U, a handicapped person. So it's not the person become handicapped of his own or her own, so that get the tax benefit. By birth I'm handicapped, and since I'm handicapped, I am giving the benefit of 80U. So a lot of deductions are there or 80 DDB. Suppose I have a family member who is suffering from, don't take it otherwise, suffering from cancer. So since this is a terminal disease, if I make an expenses, I am given a benefit. So it's not that I am maintaining this for the purpose of getting the benefit. This is my duty to maintain. And since I am maintaining, they are saying yes, you will get some benefits. But now these all benefits are taken away. So be very careful about that. So and to me, please bear in mind, it's a case-to-case basis. Don't assume anyone. Suppose two people having same salary. Suppose we two are, as say, an associate professor of a college, and we are having a same salary. But that doesn't mean that both of us will go for old or both of us will go for the new. It's a case-to-case basis. You have to see. My suggestion is you have to compute tax under new scheme. You have to compute tax under old scheme. Then you think which was beneficial to me. But there are maybe certain thumb rule. I just going through some of the thumb rules, taking some of the figures. Basically, those who are starting their life, they have joined. So they have technically lower amount of deductions. So for them, the new scheme maybe, once again, I'm using the word maybe beneficial, because I don't know if suppose a newly joined one, suppose 2 person newly joined in a college, and one doesn't have any loan, and another he or she started a house for which he or she has a loan. So you have to consider those items. So you can't say, sir, we both are joined on the same day, our total gross salary is the same, so our scheme must be the same. Not at all, because that person who has taken the loan for self-occupied house, so he or she will miss 24B, or that has to be considered. I can prepare a lot of problems that the same salary structure, but other things are there, scheme is not the same. So please don't go by shutting your eyes that you are old, right? Now the question is, I should have said this much earlier, that who can get this benefit? This benefit is, we can, if an individual or a HUF, right? And the question is, when do I get? That is a very interesting question. When do I get? When I have to say, if you see the act, it's specifically stated there are 2 cases. Individuals and HUFs are divided into 2. One is having business income and one is having no business income. I takes up no business income first. So if I don't have no business income, I can opt for the scheme at the time of filling my return, right? And for the business one, they have to give the choice before filling up the return, those who have the business income. Now the question is, when I opt for this in year 1, can I change it? Right? Suppose in year 1 my new scheme is beneficial. Year 2 I find no, scheme 1 is not beneficial. I have certain other deductions, so scheme 2 is beneficial. So for the people who do not have business income, they have the benefit of changing in each year. Each year you can change it, right? But very unfortunately, those people who have got a business income, they can change only once in their lifetime. One time you can change, after that you cannot change, right? Now a question may be raised that since I have told that I can opt for these at the time of submission of the return, but the question is, what about the TDS? What about the TDS? Because the employer need to got TDS. How I'm sorry, how employer will know I am in an old scheme or I am in a new scheme? So technically you have to put new or old scheme to the employer, right? But the CBDT has issued a circular. It's very interesting. C1 2020 dated 13th April 2020, and they specifically stated no harm in that. Suppose at the time of giving my employer, I said I am opting for new one. But at the end of the year, I find no option 2 is beneficial to me. I can go for option 2 because at the time of return, I have submission of return, I have to give the option, right? So I can change it within a year. I can change it because circular is there. There is a specific circular to that. So I can change it. and plus every year I can change it. So every year you got to see the certain things, that whether old scheme is beneficial and the new scheme is beneficial. Right? I add to one small thing which I forget in case of dividend. Please, I'm just reverting back. So when you get a dividend, you know the dividend is income from other sources. So you got some deductions, you know, that any expenses earned, any expenses made to earn the income is, I guess, deductible. But the problem is they have changed in 57. They said only you can get a deduction to the for the interest only, that to 20% only. That means you cannot get more than 20% of your interest. Suppose I'm getting a dividend of 100. I'm giving an example. So for 100, I have taken a loan. Say my interest I am paying is 32. So normally my net income should be 100 minus 32 equal to 68. But earlier one, it was there. But now they said no, it is capped to 20%. That means if you got 100, you can only get 20. So your taxable income is 80. Right? And the employer will also make your TDS because now it is taxable. So 194, if your dividend income is more than 5,000 or your unit income is more than 5,000, they will deduct TDS, right? So whenever you get, so you will get an income. If it is your income is more than 5,000, you will get an income of net income after deduction of TDS, right? So now the last section I wish to talk is that this benefit lost. So you have to compute these two separately. This is a very, very important concept. And then you may raise a question, sir, then why should I invest? Now I told to everyone, some of the investments are not only for tax purpose. To me, life insurance, it's not for the tax purpose. Yes, I'm getting a tax benefit, but this is for the good of my family. If I'm not there, how my family will run? So this money can help, or the health insurance. Do you think we are doing health insurance now for the purpose of tax benefit? I don't think so. Because if I don't have health insurance, simply I will die. You see what happens in COVID. Simply people will die. So these are the investments which there will be. So I think Professor Partho Chatterjee has raised a very valid point that government is saying that since you are paying lower amount of taxes, your disposable income will be more. But I think some investment I will do whether I got a tax benefit or not. So technically, I'm not very sure whether for individual disposable income will be more, because if suppose take a case, I am opting for new scheme, so I won't get any deduction. Do you think from the next year I will stop my health insurance? No, I will continue this. So I am not very sure that this logic that it will increase the disposable income to a great extent. I'm not very sure, because there are certain investments which I'm bound to do, whether I got a deduction or not. I'm bound to do that. So I'm not thinking that in case of a person who are getting multiple deductions. Think of a senior citizen, 80 TTB. You are getting interest up to 50,000. Interest on savings bank, on fixed deposit up to 50,000. You are getting a deduction, but now you are not getting it. So these are the things. So but nothing to be done since. But my suggestion is, whosoever you do that, please make a small computation. First, you take the old scheme, you take all the deductions, all the benefits, you compute tax, and then you go for the new one. I got a thumb rule. Thumb rule is, if you got an income of 15 lakhs or more under the old scheme, and you know that under the new scheme your income will be more because you are not getting a deduction. And if there is a difference of 2,50,000, so up to 2,50,000 you can go for the new one, but if it is beyond 2,50,000, then old scheme is the beneficial. That means what I wish to say, suppose my income under the new scheme is old scheme is 15 lakhs, and my income under new scheme is 17,50,000. So how much is difference? 2,50,000. You compute it, your tax will be exactly the same. Exactly the same. So every 2,50,000 it will be exactly the same. So if your total difference is more than 2,50,000, then you should remain in the old scheme. But if it is less than 2,50,000, then the new scheme will be beneficial. But this is a one simple case of only 15 lakhs. Because after 15 lakhs, the rate of tax is 30% same. Up to 15 lakhs, there is a differential rate. But you forget about that. The simple thing is two computation. One compute under old scheme, one compute under new scheme, and see that how much is the tax payable, and accordingly you opt, right? And once again, you can opt at the time of you can give it to your employer, and subsequently you can also change it, right? And then I will transgress. I will do something. I will take 5 minutes more. I will talk of something which is done after budget 2020. Then during COVID, there are certain changes, small changes. That is now our return of income we can submit on 30th November. It has been increased. But the interesting thing is there is a lot of changes in ITR 1 and 26 AS. You will believe or not, 26 AS got a huge changes. And a person will be shocked to see that 26 AS. Now it contains everything. We call it in Bengali Kushti, our Kushtir motto. It's a huge one. It given me everything. It talks of your cash transactions. If you deposit 1 lakh or more, that will appear in your 26 As. It talks of your investments in shares, debentures, bonds, everywhere. It talks of your credit card transactions. Although there's a limit, credit card transaction as well as foreign currency transactions. Suppose you go outside India, or your son or daughter is doing some courses there, you are sending money, so everything will appear. So 26 As, that means within 3-4 years we have going into auto fill return. You need not have to do anything, it will be automatically filled. So be very careful about that. 26 As and also your ITR 1, which is a very popular one, Sahaj, that has been also changed. 80D, now they ask for a lot of information. Health insurance, earlier on it was not there. Earlier on it was only 80G. Last year the 80G, or yes, last year I think so, or the maybe year before last year. Earlier on it was simply 80G, 80C like that. But 80G you have give a lot of information. In this year 80D you got to give a lot of information. So please bring this in the mind. I'm trying my level best to talk about these changes. Next slide, please. Devashish, next slide. I thank you for everyone. I can't say for giving me a patient hearing because everyone is sitting in your home. I thank everyone. If you do have any question, you can raise it. I will try to give answer. Thank you. Thank you.
Our honorable speaker has concluded his speech now. Thank you, sir, for your valuable speech, which helped us in enriching our knowledge about the different provisions in the new tax regime. We shall now begin the question answer session. Participants may write their queries and comments in the chat box, which will be presented to our speaker, keeping in mind that there is a time constraint. I would request Professor Poorna Banerjee, our colleague of the Department of Commerce, to conduct the question answer session.
Thank you, sir. Am I audible now?
Yes, you are audible.
Okay. The first question, one of the participants has asked for a clarification once more regarding exemption on house building loan interest amount.
House building loan interest amount you won't get if you got a self-occupied house. Then there will be no interest on loan. But if you let out your house, you can get interest on loan.
Okay. One more question. This exemption, is it applicable in new scheme?
Which exemption? I'm not talking about. I talked about a lot of exemptions.
No, this house building loan exemption. House building loan.
Okay. I got the point. The question is, I've given you are not getting any benefit of 24B or 80. That means the principal amount which you are repaying, you are earlier getting benefit under 80C, but you are not getting that. As simple as that, because you are not getting 80C. So all the elements of 80C you are not getting. So now you are not getting anything for the house building. Neither principal repayment, not the interest.
Okay, fine, sir. It's my question. If not, if this is not applicable in the new scheme, it is not. If not, then will it have any impact on real estate sector, sir?
Yes, it will. It will. It will impact the real estate sector. But once again, Pawan, I told you that when we do something, not always that it is for the tax purpose. I need a house. Take me plainly. And is that important? If I don't get a house, the benefit, I won't go for a house purchasing. I will go for. This is what I'm talking of. These people should consider this. Some expenditure are not for the tax purpose. I'll have to do that. This benefit should have been given.
Okay. Okay. Sir, what about P-tax deduction? Is it still there?
No. You read it very carefully. They said deduction under section 16. They haven't said anything. 16 means I will consider 16 1, 2, and 3. 16 are got 3 parts, so you won't get professional tax deductions.
So if not, then it will be will it be a case of double taxation?
It will be a case of
double taxation?
No. Just a minute. This is what I'm talking of. They said I'm giving you a carrot. So if you take the carrot, you have to forgo this. No way. No question of double, because you are getting a benefit of lower taxation. Now you are giving tax at a lower rate. So they said no question of double because you are paying low taxes. Yes or no? Yes. So where is that concept of double tax?
Okay. One more participant has a question. Which of the latest scheme will help migrant labor?
Which of the latest migrant labor?
Yes.
I'm talking of taxation. Do you think that migrant laborers are paying taxes? And you know, up to 250,000 per year is exemption. So I don't know how many of the migrant laborers are earning 250,000 a year. So if they don't, and you know, if someone agriculture is, agriculture income is tax free 10-1. So there is no question of any scheme for them, right? I hope so. I hope every day, one day, all the migrant laborers will pay taxes, and we need to have some schemes for them. I hope so. I hope so. So.
The next question is both intra-head set-off and inter-head set-off of loss from house property not available under alternative tax regime.
No, I'm not telling that. Please don't get confused. I'm telling this is only applicable for self-occupied house loss, not for let-out house. Let-out house will remain the same. Okay. Let-out house, there will be section 70 in the first year. Then if you carry forward section 71 in the next year, I'm only talking about the loss which arises on self-occupied house.
Okay. And the last question till now, what about STCG and LTCG in case of salaried employee? Is there any tax benefits? Please clarify.
Excellent. This is a very good question. Since the time was running out, I'm not going into that. Basically, capital gain technically remain untouched. So you will get everything. Your lower tax at 111A, 112A, that is at 10%, 15%, that will be still there. So they have untouched the capital gain. So capital gain will remain exactly the same. Whether you are going for the new scheme or whether you are going for the old scheme, it will remain the same. Absolutely. Thank you for the question. Thank you.
One more question.
Who raised this question?
Exactly, it is from YouTube, so the name is not.
Okay. Thank you for raising the question. Thank you.
One more question is there. Which scheme suppose launched for women self-help group in the budget?
Launched for women self-help group in the budget. No, basically, don't take in that form. They haven't said normal business loss is not to be set off. They only said business loss pertaining to the deduction which has been disallowed. That means suppose your loss has a component of additional depreciation, only that part not to be considered. But other businesses you can safely carry forward and set off. It is not at all that. And plus, mind it very carefully, this is only for the individual one. Think of the company, but if an individual, he or she can jolly well do that. Only part, say 35. 35, you are not given the benefit for the payment to the third parties. So only that part will be disallowed, not the business loss, please. But don't get this confusion. Business loss to the extent of the deductions which have been disallowed under 115 BAC.
Okay, sir. Any more questions from us or any other participants?
Purna, I have one question. I have one,
Yes, sir.
or if
Please.
the time permits, two small questions.
Yeah, please, sir.
So far we can understand there will be no exemptions and deduction under the new tax regime. But if there is any mention anywhere about the relief under section 89(1), will it be allowed or disallowed?
Very good. Absolutely. Very good. It's a very, I should have also said 87A also. Rebate. No.
Yeah.
Relief 89(1). Now they haven't said. So if they don't say anything, that will remain the same. So you will get relief. Definitely you will get 89(1). You will get 87A because they haven't said you won't get the benefit, right?
Yeah. Because there is no circular. I have just searched out, there is no circular.
Now the problem is, if you are not stating anything, I will assume other things are status quo. Simple. Whatever is there, that will be there. Unless you said you won't get, I will assume simply the status quo. So simply you get 89(1) as well as 87A also. You have the benefit of 87A also.
Okay. And another one, very small question. In case of self-occupied house property,
right.
You told that although from the previous year 18-19, 2 self-occupied house properties will be choiced by the SSC. So, but the total deduction under section 24B will be untouched, 2 lakh rupees.
Absolutely.
But let us a case. If I have 2 houses and it is named for my spouse and me, the other SSC. I have 1 house, I choiced 1 house, and my spouse choiced 1 house. So would they get 2 lakh for these 2 claiming these 2 houses as self-occupied house?
Got your point. In case of house property, who is the SSC? The owner. Owner is the SSC. So house 1 owned by you, house 2 owned by your wife. So each one can take it separately.
Yes, yeah, I think also.
Because the question is, if your name, there are 2 houses. This talks of 2 houses in one SSC's name. Otherwise, if you can. But the problem is, the problem is, think of section 27 deeming prohibition. If you transfer, you will be treated as a deemed owner. Or my suggestion is, it is better you pay cash to her and ask her to purchase a house, then you can bypass 27. But once again, there is a clubbing provision. If that has been let out, then 64 it will be up in your hand. But everything has to be. If you make a plan, the plan must be foolproof. This is my question. Now, before I end,
with my wife, just question.
I wish to say one word. Purna, is there any question more?
No more question.
So at the outset, I thank the college authority, especially Professor Sudhin Bera, for giving me an opportunity to share my views with so many people. Thank you, Raja Peary Mohan College Authority, Sudhin Bera. I thank Partho, Purna, Devashish. Each one is helping me. Thank you. Keep safe.
Thank you, sir.
Yes, please.
Now we have almost come to the end of our webinar. I shall request Dr. Sudhin Kumar Bera, our senior-most member of the Department of Commerce, to give a vote of thanks.
Okay, ladies and gentlemen, it's my privilege to have been asked to propose a vote of thanks on this webinar. I, on behalf of Department of Commerce and IQAC, and on my own behalf also, extend a very hearty vote of thanks to our speaker for gracing this webinar. A big thank to Professor Basu for his efforts highlighting various key changes and enacted in Budget 2020, which specifically affects personal tax planning. I would like to take this opportunity to place on record our hearty thanks to Dr. Sudeep Kumar Chakraborty, our principal, for his logistic support and guidance he has extended for organizing this webinar. I also extend my thanks to our IQAC members of our organizing committee, teachers council, EBB members, non-teaching staff, student union, and particularly to our support staff for their enormous cooperation in organizing this event. And lastly, I would like to thank all the distinguished faculties of different institutions, professionals, research who has a grand success. Thank you, everybody. Thank you. Now I would request PSC sir to announce closure of this webinar.
Thank you. Once again, I
Yes,
thank
sir.
all the participants for attending this webinar and patiently listening to our program, making it successful. Stay safe, stay indoors.
Thank you.
I also thank Shatadru and Ovik. Sorry, I missed that.
No, no, thank you, sir. Thank you, sir.
Thank you.